The Europeans are beginning to admit publicly that the euro system, at least in part, is breaking down. At present, the biggest issue of public concern, of course, is Greece, which is simply unable to sustain its budget even with €250 billion of debt write-downs and bailouts. It could either leave or be ejected from the Eurozone in upcoming weeks. This is sparking endless debate among policymakers as to what to do. After all, the risks of contagion from Greece seem pretty extreme. Not to mention considerable, fervent contingency planning among firms about how to limit their losses. Of late, Stratfor has seen a number of creative suggestions pop out into the media, and we feel drawn to comment on one in particular. This week, representatives of Deutsche Bank suggested Greece adopt a quasi-currency called the Greek euro or gyro. The gyro would in essence be IOUs issued by the Greek government to pay its local expenses. The gyro would circulate as a currency, at first parallel to the euro, but considering the volume of Greece's imbalances, it would quickly become the dominant currency and vastly depreciate, giving the Greeks a chance to restore competitiveness. Once an agreed-upon level of competitiveness was reached, the euro could then be readopted at a lower exchange rate. Greece stays in the European system, there's no disorderly credit event, and Greece rejoins the system at a more sustainable position at some point in the future. Right? Not really. Stratfor sees the gyro as, if anything, more symptomatic of the Eurozone's problems than a possible solution. The Greek economy is as deliciously non-competitive as the German economy is hyper-competitive, yet the two are members of the same currency bloc. This competitiveness mismatch is the core cause of this crisis. Germany exports goods and capital, while Greece imports goods and capital. Eventually, Greece runs out of money, leading to massive borrowing, and now not even that is sustainable. The gyro plan doesn't address this mismatch. Instead, it aims to preserve the mismatch for just a little bit longer. The adoption of the gyro would guarantee Greece's debts. In fact, bailout funds would continue to be sent to Athens to keep the system going. However, no one in their right mind would even consider sending private capital into Greece. Even under the gyro, they'd still be in financial receivership. So Greek exports might be more competitive with a weaker currency, but without outside investment, the Greeks would still be unable to stimulate economic activity, up to and including exports. The Greeks would also remain fully liable for the full value of their debts that are euro-denominated. But the Greeks would be operating in a currency that was now substantially weaker. Greek debt levels relative to GDP would actually rise, not fall, making a long-term recovery even less likely and impoverishing the citizens even more. The only winners? Foreign banks who had exposure to Greece. As part of the plan, they would have their assets guaranteed at current levels, and they could probably count upon a flood of ECB resources in order to maintain the stability of what's left of the Greek banking sector. No surprise that the idea came out of Deutsche Bank. Most of these solutions that we have seen to the Greece imbroglio follow this pattern of looking out for the interests of a particular party. Still, the fact that the Europeans can even have this conversation with themselves is actually a positive sign. Since the European financial crisis began over 2 years ago, banks have been steadily limiting their exposure to Athens, and now the vast bulk of Greek debt, whether public or private, is held as collateral at the ECB or the IMF, and most of what's left is held in Greece by Greeks. Government monetary authorities do not go bankrupt in the same way that private companies do, and not a lot of Europeans care about what happens to the Greeks who actually stay in Greece. A Greek default would no longer automatically trigger a European, much less a global, financial cascade. Total private losses now would probably be below €150 billion. That hardly makes the increasing likelihood of a Greek default a non-event, but it does demote it to a merely survivable one.